has? I mean, I know that, in a rising rate environment, you would see the yields pricing in the tightening of the rate curve. Do you think that's what's happening with high yields right now? This is not just an Indian phenomenon?
Yeah, I think there is a couple of trends happening. One is the market obviously got well ahead of itself, and we saw, let's say, between February and a few weeks ago, the 10-year largely remaining in a range. And then there's been a breakout over the recent past, and that's, I think, more driven by the currency than the previous concerns on the rate stance. So it does appear that this recent depreciation of the currency is really forcing the markets to reevaluate what the RBI will do, and I think now we are moving beyond maybe one rate hike expectations to maybe at least two rate hike expectations.
Yeah, indeed. So what's the outlook then for FY19? What is your view on liquidity situation? Because globally things are getting, beginning to get a little awry. Do you sense that locally as well, liquidity could continue to be a challenge, or do you not believe that would be the case?
I think RBI is going to maintain what they call neutral liquidity. So that implies that the RBI is there and they want to ensure that liquidity doesn't get too tight in domestic market. Now, let's also look at another factor, which is when the RBI intervenes to sell dollars to stabilize the currency, which they have done over the course of the last several months, that sucks out domestic liquidity, and the RBI therefore will have to intervene more through open market operations to add liquidity back into the system. But now, if the RBI has stopped intervening as much and the depreciation of the rupee from 70 to closer to 72 suggests that the RBI may not be intervening as heavily, then the need to do open market operations comes down, and that removes one very important support to bond markets. So while even as liquidity will remain a lot more contained and there will be no pressure on liquidity from forex sources, I think bond markets are probably not going to be very happy with that.
How do you read into how bad the currency situation can get from here?
So that's something that is very difficult to predict. The way I look at it is the impact. I mean, let's look at what happens if the currency depreciates rather than taking a view exactly on the level of the currency. And the way I see that is, if the currency were to depreciate and the RBI does not intervene, then RBI will have to change its forecast on inflation. That implies getting hawkish at the margin. And second, like I said earlier, they may not intervene as much through open market operations, which is not good news for bonds. So overall, I take this rupee move in the recent past as being quite negative for bonds. And one last thing, which is, if RBI is no longer intervening directly in FX markets, then the only other solution they have to hold the level of the rupee would be to raise rates. So as the rupee keeps depreciating without major intervention, the markets will start to believe that the RBI may change its stance and get more into a rate hike mode to preserve the value of the currency.
We have enough forex reserves if the weakening bias for the rupee continues.
Well, I think they do have reserves, and that's a major source of support. We were, we have burned through some of it, maybe about $25 odd billion in spot and maybe another $10 odd billion in forward. So that implies maybe about 10% of the reserves have been already used up. So at some level, RBI will say, should I keep running down my reserves, or let the rupee find a certain level and then intervene so as to kind of correct it if necessary. So that does imply that there's a potential for some overshoot beyond what one might call a fair level of the rupee, and then the rupee comes back. We saw this also in 2013, that there was a very sharp depreciation after the RBI rate hikes, but then it came back in the following few months. So I suppose we may see that kind of a reaction. That kind of short-term volatility the economy can really live with. I think if a sustained intervention from RBI which depletes its reserves may not be in the best interest.
No, that is indeed the case. How are you looking at the underlying macros kind of determining where the situation on the currency and rates goes from here, with the deficit situation widening, the trade balance looking a bit tender? the balance of payments getting more skewed with the rupee's fall and rising oil prices?
I think so. One of the things is we are much better than where we were 5 years ago. So that's a positive. Having said that, what is happening right now is not being driven by Indian macro. So we could have a stronger growth, lower inflation and no current account and still see our currency depreciate, as many of the other emerging markets have seen this year. It's just that relatively within the EM space, those countries with larger trade deficits have seen their currencies depreciate more. That includes the rupee this year. But on a broader basis, stronger macro I don't think is going to help very much, or indeed a stronger monetary reaction is not going to help very much if the entire sell-off in the currencies is driven more by global factors or EM factors rather than India-specific factors. So in that context, my expectation is, from RBI would be that RBI should not at least hit domestic macro through aggressive rate hikes. The 2013 response, again, I will allude to as almost like a policy mistake where they tried to hike rates. It did not stabilize the currency and it just led to a lot of domestic macro disturbances. So I think probably the RBI has learned some lessons from that and they may not go so hard on the domestic macro. But on a broader note, macro does seem quite all right. We are seeing better growth. Remember that a large part of the increase in the trade deficit is on account of higher imports, which is because of stronger growth. We cannot be complaining about that. Eventually, the trade balance can narrow. But for now, I think the mix of growth is pretty good.
Good to hear that. What then do you believe could be the FI debt and equity flows? Because the last month has been a good one. By the start of this month, and you've already begun to see that volatility creep in.
Yeah, I think there is a possibility that you might see some outflows, but in the balance, is that going to make a big difference to bonds? FIs own maybe 3 or 4% of the outstanding debt, so this is a very domestic driven market. Yeah, yes, at the margin it does make some changes, especially for those bonds where FIs have specific interest, but I don't think it's it shows us in it doesn't put too much of pressure on our markets. There are markets in the region where FIs own 30 or 40% of outstanding stock. Obviously, selling by FIs does make a very large impact on those markets. But in our markets, I don't see FIs playing a huge role.